My name is Jeff Reines, and I'm from Grand Valley State University. The most important lesson that I learned was working well with others and managing my time to go through this extensive process of trying to value a company. The biggest challenge I faced was, dealing with the size of Perigo. I mean, it had so many acquisitions and just so many moving parts where that was the biggest deal when I did the valuation. I do think it reflects well what analysts do. Just valuing a company, sitting down with management, knowing the industry, trying to figure out everything you can about this company. It's definitely matches what an analyst, I think, would do. It'll definitely prepare me, hopefully. I'm sitting for the CFA Level 1 in this upcoming June. It has already taught me so much, and it's also reconfirmed that what I know, and it's actually made me a lot more confident.
Good morning. We are the Grand Valley Seaman Equity Research Team, and my name is David Lowe.
I'm Matthew Merritt.
I'm Jeff Reines.
I'm Devin Alexander.
Today we'll be presenting Perigo, a generic pharmaceutical manufacturing company. Yesterday the stock closed at 108.3, and we have a 12-month price target of 102.39 for a rating of hold. Some highlights of Perigo is that fundamentally Perigo is a very strong company. As you can see, their revenues and net income have been increasing, and some of their liquidity ratios are higher than all their competitors. But one area of struggle for Perigo is that in 2013, the value of drugs that are going to be switching to over-the-counter is nearly half as much as it was in 2012. So there's a lot less growth. One drug, Nexium, that was supposed to hit the markets in 2014 is not going to hit markets until 2017, and Pfizer has exclusive rights of it until 2017. And this drug accounts for 56% of their future pipeline. And Matt will talk about other product launches.
Okay, here we display all the most current product launches for Perigo. I'd like to highlight the topical foams and also the delay of Mucinex. It was set to launch in Q2 of 2012, and now we're looking more about March of this year. We think this is attributable to organic sales, which have been growing at a much lower rate than inorganic sales and at the rate of the company itself. On a much broader view, Perigo is the world's largest over-the-counter store brand supplier of pharmaceuticals, nutritionals, food supplements, and things of this nature. Their products are sold under brand names such as Walmart's Equate, CVS, Rite Aid, pharmacies, and things of this nature as well. In terms of global presence, they are dominantly in the United States, with firm presence in both Israel and Mexico. Moving forward, we see room to grow in the China market due to they are the largest infant formula market in the entire world, and recently Perigo has taken many steps to vamp up their segment of infant formula. In the United States, we see room for growth strictly due to expansion in the United States, predominantly in Michigan. In Holland and Allegan, they are currently expanding, and they have historically received tax breaks in Michigan. As far as segments, consumer healthcare makes up 57% of all their revenue. The graph also displays the breakdown of the consumer healthcare segment. Besides consumer healthcare, we have prescription drugs at 19% and nutritionals at 16%. In terms of segment trends, we can see over time consumer healthcare is becoming less and less weight as far as overall segments. In place, we see prescription pharmaceuticals as well as nutritionals taken over. Prescription pharmaceuticals have a higher operating margin, but nutritionals have a lower operating margin. Thus, we are projecting a slight increase in operating margin, but just slight. In terms of growth drivers, one of the biggest growth drivers we actually see is Teva's launch of Temodar that is set to launch this fiscal year. Temodar had sales of $1 billion last year, and Perigo is actually supplying the active pharmaceutical ingredient to create the drug. This is going to give them 50% of all profits of Temodar generic sales. In China, we'd like to cite again the over-the-counter market growth that we see as a room for growth for Perigo. And through acquisition, they now dominate the pet care, diabetes, and topical foam over-the-counter markets. I'm now going to turn to Jeff to speak about valuation.
Yes, we use two different types of analysis for to discover our rate. We used a multiple analysis and a DCF analysis. The multiples that we used was an EBITDA of 15.1, a PE of 22.41 and an industry average PE of 22.1. The weights that we used was a 50% weight of the multiples and a 50% weight of the DCF analysis to arrive at our price target of 102.39. Going forward, we used a perpetual growth rate of 2.5%, and taking into account the cost of equity and the cost of debt, we determined the WACC to be 7.9%. Sales going forward would be we projected to be 16.6% using the 4-year average. Depreciation and amortization going forward was 2.8%. Capital expenditures going forward was 3.3%, and we determined a tax rate of 24%. Now I'm going to turn over to David for acquisitions.
In order for Perrigo to continue growing at the rate it has been, Perrigo must be very aggressive with their acquisitions. As you can see, 40% of their sales were from inorganic growth, and compounded annual growth rate for inorganic sales has been 44% over the last 8 years, compared to only 7% for organic growth. Some of the most recent acquisition that Perrigo has made has been helping them to diversify their products, to help them grow some more. One company is Can-Am, which has provided them 100% market share of over-the-counter diabetes healthcare products. Surgeons and Valsera are in the pet healthcare industry, and from the next graph you can see that the total spending on pets have been increasing steadily, and so we see that this is a very good place for Perrigo to grow. Matt will talk about the industry overview.
One key feature of the generic pharmaceutical market is when a brand name drug comes off a patent, the FDA is going to determine whether they think a generic alternative is suitable for the market. If they think it is, then generic drug companies are going to fight tooth and nail to get to the abbreviated new drug application to the FDA first. If they do get it to them first, they have a chance at 180-day exclusive rights to that drug, which can be very profitable for these companies. The graph here is going to display that generic drug sales have been growing at a faster rate than branded name drug sales, but cost of goods sold have been high through the years. Speaking a little bit more about gross margins, in terms of their key competitors, Perrigo has lower gross margins than all of them. They do have higher operating and profit margins than most of their competitors, however. Getting back to the abbreviated new drug applications, we see here that Perrigo has been way behind the curve in terms of its competitors and the industry average for approval rates. As I spoke earlier, this can be a very big profitable thing for generic companies, and we think that this is a trend that we don't have any reason to believe will not continue. I'm going to turn now to Devin, who will cover investment risks.
It is important for Perrigo to strive to have flawless execution because any minor mistake could be extremely detrimental to the company. Perrigo does have a limited amount of suppliers because they are single source relationships that if the supplier were to come into a problem, it could really halt production for Perrigo. And Perrigo needs to, it is important for Perrigo to protect their intellectual property rights in order to compete in the market. And consumer perception can be directly tied to flawless execution because it really depends on how consumers perceive generic pharmaceuticals in relation to prescription pharmaceuticals. And with the looming sequestration and the bringing about of the Affordable Health Care Act, there's a lot of uncertainty in the economy, and we just wanted to factor that into our evaluation. And we do have concerns about Perrigo's ability to sustain growth because they have been so successful recently in their acquisitions. And we don't have any reason to believe that they will be as successful going forward. And Perrigo is an international company, so it is exposed to foreign exchange rate fluctuations and political risk due to the stake they have in foreign countries. And as you can see behind me, there is the risks that I've discussed are in the risk matrix, with the higher impact to the right and the more likelihood to the top. And we would just like to reiterate that we feel that Perrigo is a strong company, however we do recommend a firm hold. And we would like to say thank you to the CFA Institute, and we are now open for questions.
So you're seeing Perrigo as maybe maturing from a growth company to a more stable company. At what point then, what kind of valuation do you think would be a buy?
With increasing margins, I would consider it a buy. If the PE dropped below, anywhere below an 18 to a 17, I would consider it a buy.
More of a mature company PE instead of a growth PE.
Right. Well, one thing with the acquisitions, which has fueled a lot of the growth, there's a lot of uncertainty as we spoke about, and that may incline them to sell their companies to Perrigo more easily than if the economy was, strong. So moving forward, we can see growth halting just a touch.
have they executed, what has been the history in terms of their ability to execute on acquisitions successfully?
They've been able to do so quite well, actually. Most of them are cash that they pay for these acquisitions, although sometimes they take out new debt to fund them. The process they use is they want a 2% return on invested capital, 2% above the weighted average cost of capital. This way they have a little bit of room if sales aren't as high as they projected, that they'll still be, they'll still make some money off of the acquisition.
You talked a little bit about risks, regulatory and operational risks. Can you give me some examples of that in terms of many recalls perhaps they've had, manufacturing issues, or any type of litigation that might be outstanding?
In 2 instances, in 2006 and 2010, Perigo had a minor mishap with metal shavings making their way into ibuprofen bottles. Their quality control was able to halt that before it actually reached consumers. So they do perform quite well when it comes to abiding by regulation. So they don't really have a lot of problems with that.
Yeah, and I believe it was in 2006 it was proven to be a supplier issue, but I think the other one in 2010 was on Perigo. But both times they caught it before it got into a consumer's hands.
Do they actually produce product at all of the locations shown in the map?
Well, yeah, there are some places, like I believe in India, it's mostly just active pharmaceutical ingredient. But yeah, in their Michigan locations especially, most of their lines are going 24/7, so they're using all their resource capacity. And yes, for the most part, they do outsource some, but for the most part, it's only the API that they outsource, and they do make a lot of their own products in-house.
API seems to be a higher margin business.
Yes.
How does that? Are they trying to grow that business, and if so, how does that work in terms of their sales to Teva and Temidor, for example? Are there other opportunities for them with other manufacturers?
There may be. The research and development, as we have in one of our appendix slides, is actually at a much lower rate in terms of their revenue and percentage-wise than their competitors. And a lot of API I know comes from research and development, and these are not easy things to produce, or it would be much more thriving of a business. But Perigo seen the opportunity with Temidor and really seized it, which if they can do things like that going forward, that can really jump the stock price, as it did with Temidor.
Because Teva is also a major competitor of theirs, correct?
Definitely,
So they're doing
yes.
business with a competitor.
Right.
You guys are calling for a step down in the EBITDA margin in the forecast period of about 4%. Just curious, no, 3%. How do you guys, how'd you come to that?
We came with the EV EBITDA. Their EV EBITDA is slightly actually higher than most of their industry peers. So what we took into conception is that their EV EBITDA is slightly high due to their industry, and that's why we have it at a stronghold right now.
We think that can come back down to earth with the rest of the industry.
When you look at valuation, you said that you'd feel comfortable with buying at a lower multiple as to where it is. What kind of a long-term future growth rate are you anticipating in terms of?
In terms of sales or in terms of perpetual growth?
In terms of earnings, and in terms of their earnings growth rate, and it slowing from, I assume you're saying it's slowing. You're assuming
Right,
it's gonna slow.
that's what we took into.
From what level to what level?
Right now, we took it if generics were not slowing down the way they are, we would probably took a perpetual growth rate of 4%. But since it is being cut by more than half in the upcoming year, we took it down to 2.5%.
Also, we think the economic downturn has really contributed to over-the-counter growth. People are not buying the brand names simply because of cost. And you really don't establish a brand loyalty to Perigo because it's Walmart's drug. You really don't even know about Perigo's existence. So some of these brand names can build up brand loyalty where generics really cannot.
Can you describe why on your target you used 50% cash flow analysis, 50% company comparison analysis? And if it is becoming a more mature company, and it's difficult to find a comparison, why did you equally weight it, not just do a discounted cash flow analysis?
Well, we wanted to be able to compare it with other companies, and we wanted a market view of it along with a fundamental view. We just thought that was the most important thing, was to have both sides coming into effect.
So you feel that other companies are appropriate to compare to?
Yes.
Perrigo?
Yeah, they definitely have high market commonality and for the most part, very similar resource capacity as well.
And maybe on the qualitative side, talk about management in the company. You're not losing confidence in management you are to grow the company, but they're up against obstacles that may be beyond their point. But if it is becoming a mature company, are you confident that they can manage a mature company in the future?
Yes, we do believe that, due to the, they've been around, Judy Brown, the CFO, and Joe Papa, the CEO, have been around since 2006. So they've had a lot of time to prepare them to go into the future. Again, I think their management is actually in the price and in the income statement and in the balance sheet.
Both well compensated for it too, which is a strong sign that Perrigo wants them there.
As far as that goes, what are the incentives based on for the management compensation?
Well, I know they do have stake in the company, so they do have, their executive shares. But like I said, I had looked up, and it's not the most reliable source, but I believe Joe Papa makes about $6.2 million a year. So they do want him there. They do give him incentive to, live in Allegan, Michigan, which may not be the most popular destination for a rich man, but that's where he lives with Perrigo, and he's taken the company from in 2006 to where it is now, which is vastly different.
How have they done in terms of retaining talent as they've made acquisitions?
Could you repeat that, please?
How have they done in retaining the talent, the management teams of the acquired companies, and integrated those into Perrigo?
In terms of integrating the companies, the cost of integrating the company has not been too high. I'm not sure about if they have kept the management from the or from the acquisitions or not, though. But in terms of integrating, we can see that they have done a well job, and each time they do acquire a new company, the performance of Perrigo and the revenues have increased. So all their acquisitions have been very beneficial for the company so far.
I'd like to highlight one more thing about acquisitions. With Colbreck, that got them in the topical foam markets, and one thing Colbreck did to make the buy so attractive to Perrigo is they actually went out and they received 180-day exclusivity of the Luxic foam generic. So that's one reason that Perrigo struggles in that department. So the fact that they were able to offer them that really might have increased the incentive for Perrigo to go ahead and make the purchase.
This is a question outside of making the recommendation, but if you were revising the board and most of their compensation is tied up in stock, how would you find value? Is it more valuable as parts of the company right now? Are there segments that are growing better, that may be better than the company as a whole?
Could you repeat the question?
Yeah, I'm saying if you were recommending to the board,
Okay.
obviously you're saying it's whole, it's a mature company, but is there some value in there? Are there segments? Consumer healthcare is a large part, and they're getting into other pets. Is there segments that might be more valuable as pieces? Is the sum of the whole less than the parts?
Okay, so one thing, like with the prescription pharmaceuticals, I showed the trend. They're trying to increase that segment, but as we said, the value at risk is, it's declining going forward. So what they've tried to do is add some of these acquisitions, such as the Surgeon's Pet Care. It has really high margins compared to the rest of the consumer healthcare segment. So they're trying to lift that via acquisition. A lot of what they've done recently has really been inorganic and with acquisitions, and I think they're trying to play around with their margins and their segments in that way.
So how does pet care then fit in with the other portfolio, the businesses?
For the Surgeons and the Valsera, it's also pet healthcare. And so pet healthcare, a lot of it is for trying to keep the pets or keep ticks and fleas off the ticks. That's the main business that they're in. It's not so much pet. For pets, it's not really like food or just like normal pet products. So it's still in the healthcare industry, just not for humans.
Not for
Thank you.
Thank you.